You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, you know what that music means. It's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from this here ever-expanding, ever-exciting Options Insider Radio Network. Speaking of that expansion, if you haven't had a chance to check it out yet, listeners, I encourage you to check out our latest edition, our Options Oddities program. We do that every day live in the swim lessons room over there on the TD Ameritrade platform. So if you're a TD client, maybe thinking about becoming one, surf on over there and join us every day live at noon Central, 1 p.m. Eastern. You can follow along with our charts, our screencasts, and all of the fun, unusual activity we dig up for that program. And you can find that show pretty much anywhere you find Volatility Views and all the other fine programs on this network, including the mothership, theoptionsinsider.com, from whence all of this content flows. And if you haven't been back to the site in a while, listeners, I encourage you to do just that. We made a lot of tweaks up there, a lot more visually pleasing to the eye, a lot of more content tweaks. And of course, you can find all the archived episodes of Vol Views and every other episode and every other program on our network. And you can also find them, of course, via our mobile app available for iOS, Android, and the Fire OS. You can instantly stream all of your favorite episodes of Volatility Views. You want to go back and say, hey, I want to listen to that episode where they had Robert Engel on again talking about all sorts of fun volatility stuff. You can do that. You can download that for offline listening if you're on a plane or on a train. And then you say, hey, I really disagree with that Jared guy. He's kind of crazy. Let us know. Write it in. We baked it in to the app to make it even easier for you listeners. You can shoot us a Facebook question. You can shoot us a tweet. You can shoot us an email. Even leave us a voicemail, all right there in the app. It's really cool. Check it out. The Options Insider Radio Network mobile app available for iOS, Android, and the growing Fire OS. All right. And joining me on the old Volatility Views panel, beaming in from that mecca of financial research known as BGC Partners, none other than Mr. Jared Woodard. Jared, welcome back to the program, sir. It has been too long. It feels like it's been a week.
Yeah, it has. I'm really happy to be with you, as always. So, yeah, great.
Yes, indeed. And joining us today for our guest host slot, he's been on before, listeners, and we liked him so much we wanted to bring him back on again. Mr. Russell Rhoads, volatility and options author extraordinaire and educator over there at the Options Institute. Russell, welcome back to the program, sir.
I'll tell you, Mark, I'm going to take you along the next time I go to a family reunion so you can explain to these people what I do.
I've known to give a good intro or two.
I appreciate the introduction.
And listeners, we should be joined in progress by Mr. Mark Sebastian, the greasy meatball, probably late as usual, but he'll be joining us. And I think he's going to want to join us today because we have a pretty interesting topic to dive into in our Volatility Viewpoint segment. So let's do just that and dive right in.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
I love that transition. Always makes me want to just keep on going with the song and just rock out here on the show. But we have a show to do, listeners. No time for that. Welcome indeed to our Volatility Viewpoint. This is indeed the portion of the show where we usually welcome on guests from throughout the world of options and volatility and proceed to pick their brains. And we've had Russell on before, and we've talked a lot about a lot of interesting stuff. But today we have something interesting to talk about because he and Mark together cooked up an interesting new white paper talking about some of the other interesting products that we don't talk about a lot here on the show, but are still pretty interesting from a structured product and from a trading perspective. Of course, we're talking about a lot of the BuyWrite products floating around over there at the CBOE. We've talked about BXM in the past, but there's also other flavors. There's the out-of-the-money BuyWrite, and there's a lot of cool things you can do with those products and those indices, and that's kind of what Mark and Russell explored in this white paper. That's my 10,000-foot view of it, Russell, but you spent a lot of time crafting this. Why don't you go ahead and tell our listeners exactly what you and Mark were working on here with this paper and what the point of it was?
Well, gosh, that I could come at this from a couple of different directions. But what we did was we took a look at, and this is a terrible name, so I'm going to say it once and then refer to it by its ticker from here on out. But we took a look at the CBOE S&P 500 2% out of the money BuyWrite Index, which is quoted under the ticker BXY. BXY is it's outperformed on an absolute and a relative risk-relative basis against the S&P 500 total return over the 25 years plus that we've been tracking BXY. Basically, what happens is on the third Friday of each month, we take a look at where the S&P 500 is mid-morning, and we add 2% to that, and then the next strike up is actually where we'll sell SPX call options against a long portfolio that has exposure to the S&P 500. Over a 25-year period, the average return on BXY has been about 8.75%, 8.78%. The same time period, the average annual return for the S&P 500 had been 7.37%. A lot of portfolio managers like to show their risk-adjusted returns, and the annualized volatility over that time period for the S&P 500 was 16.4%, and for BXY it was very close to 13.4%. So we looked at that and we thought, well, what if you started to leverage BXY up? And if we looked at 10% buckets, 110% to 150% leverage using BXY, and the interesting outcome was with 120% exposure to BXY, the average annual return is 10.4%, and with the annualized volatility being 16.2%, which is just a tad under the type of volatility that you would have experienced over that time period with a buy and hold portfolio. The motivation here was to approach BuyWrites in a more aggressive manner. You often think of a BuyWrite or a covered call as that very first option trade that people that are starting to gain experience with the option market should use, or kind of a conservative long-term investment approach. But you could also leverage the risk up and do even better than the unleveraged BXY performance relative to the S&P 500.
I love this kind of research, and this goes back to what I've seen with OIC doing a lot of this kind of stuff too. They take a strategy and investment that is, like you said, otherwise considered very alternative, is considered to probably underperform in a lot of different environments, and then they blow the doors off that with some actual hard data and some actual hard numbers. OIC did that very, very famously with a lot of their collar studies. You guys are taking a similar approach and actually adding on to it a bit by offering some leverage components to a product like BXY that really doesn't get a lot of love out there. Everyone, if they do talk BuyWrite, they typically talk BXM, which, and BXY, you're right, does outperform. It has that little bit of appreciation built into it because it is a 2% out of the money, right? It's not, you're not just clipping right away at the money every month. You're giving yourself a little bit of room to run on the upside, which I think is natively more appealing to a lot of that advisor, asset manager audience anyway. They own the underlying because they want it to run a little bit. But this approach shows that you can take that and just kind of tweak it a little bit. This isn't something overly complex people can't do on their own, and turn those returns into something really impressive.
Yeah, it's funny you mentioned that it's not overly complex and individuals can do it on their own, because I got I put a link to this study up on the CBOE's blog site yesterday, and actually got a comment that I just came across as we were getting online here, where somebody was suggesting we take a look at doing the same thing with the PUT index. Well, I've already run the numbers, and we actually have you can outperform with lower risk using the BuyWrites Index, which basically sells at the money put options against basically a cash holding. The reason that we chose to start out, or kind of have our first paper be about a BuyWrite instead of a PutWrite, is because it's more appropriate for a much larger number of investors.
Yeah, we of course have had famous discussions here on this program about put and its lack of love out there for a variety of reasons. We even had the creator of the BuyWrite Index come on to explain why he thought some of that was interesting stuff. I'll be very looking forward to your put version. All right, Jared, I know you do a lot of these kinds of studies yourself and a lot of research into this space. What's your take on this approach to BXY, using this leveraged approach to kind of kick it up a notch, to borrow a phrase there from Emerald?
Yeah, it's an interesting place to focus on. Looking at that 2% level is interesting to me, rather than the at the money that a lot of people are familiar with. And the first thing that comes to mind that maybe Russell, you could speak to is how the given that fixed 2% strike, and how that can be more or less sort of close to the money, depending on how volatile the market is at a given time. I wonder if you found any relationship between different phases of the market, maybe different market cycles, and how that fixed 2% moneyness level reacted in terms of profit loss and in terms of risk.
Well, the time periods that just about any BuyWrite underperforms is when we get into a strong bullish trend. In fact, one of the things that led us to looking at leveraged BuyWrite strategies was the performance in 2013, when you left a lot on the table, even if you'd been selling out of the money call options, not just at the money call options. The funny thing about this leveraged approach that is a little bit counterintuitive is the leveraged BXY outperforms in strong markets to the upside, but actually it underperforms when the S&P 500 is having a strong move to the upside. It also underperforms when you have a strong move to the downside, and that leveraged exposure to the S&P 500 starts to overtake the income that you've taken in, and you actually would have some underperformance on both tails, for lack of a better way to put it. And I put a payoff diagram in the paper where I show the payoff for 120% of the BuyWrite versus the S&P 500, and you can actually see on the left side the 120% BXY starts to underperform, and then of course on the upside, where returns are capped, it underperforms as well.
All right, listeners, and better late than never, we are joined by the greasy meatball himself, Mr. Mark Sebastian. Mark, welcome to the program, and give our listeners some insight into why you wanted to work on this paper. What was your thought process going into this?
Well, one of the things that I've noticed is how little there is in the advisor space in terms of really understanding how these strategies work. Even on a show that's as good as Advisor Options or OIC, they spend a lot of time looking at individual use cases and they don't spend a lot of time looking at big overreaching, hey, here's a way that really any advisor could add value added to their product. This is something that a version of this can be used over advisors that like to pick their own stock against advisors that really things. On top of that, on retail investors, people with large books of stock that maybe don't understand where the value added is in this. I mean, I think the fact that we showed, well, you know what, you get slightly better return with much lower standard deviation without levering, and then what you can get out of levering. I mean, that's what really drew me to the paper and drew me to working with Russell. Honestly, when Russell says, "Hey, this is something I'm working on. Do you have interest in working on it with me?" I'm all over it because I really enjoy working with Russell on projects because of kind of what he brings to the table. Just vision and the ability to really the ability and want, the will and volition to dig into a subject and accept whether wrong or right. I mean, I'm sure Russell maybe told you that, but our original idea to this didn't pan out, and so we spent some time really digging into different ideas that we wanted to do, and this is what came out. And I like to joke that I am the Myron Scholes to Russell's Black in terms of how much work I did relative to the amount of credit I'm getting. But it was really just fun, and there's a huge hole in BuyWrite papers that have been written recently. I mean, I think it's been 10 years or something like that, and there's absolutely nothing on levering, and a huge portion of the high net worth individuals lever, and this really allowed us to dig into something that I think a lot of people are going to like.
So Russell, what's the next steps here for this paper and this idea? Is this kind of just a thought paper you want to put out there to get people thinking? Are you going to go on the road and start beating the drum for this approach at various advisor events and saying, hey, you should be using this levered approach? Are you maybe going to sit down with the product guys over there at CBOE and cook up some incarnation of a BX type product that incorporates this leverage approach? What's the next steps here?
Well, I'm scheduled to speak in front of about a half a dozen CFA chapters this fall, so it's something that will come up when I'm doing that. Mark and I are actually going to do on December 2nd, I believe, we're going to do a webcast where we run through this a little bit, step by step, what the research part, what was involved in the research, along with how you can go about structuring a 120% of exposure to the out of the money BuyWrite. And then we're actually going to do a class in mid-December as well, where we spell this one out. We actually run through some of the other structured products or I shouldn't say structured products, but indexes that follow systematic strategies that we have here at CBOE and how to actually implement them. Sometimes you see these great strategies, but there is some work in kind of a learning curve on how to go about implementing them, and we're gonna work on making that easier for people.
I'm glad to hear that, because one thing advisors like, well, of course, they like good risk-adjusted returns, but they also like ease of implementation. So if you could work on both of those things, I think that will go a long way towards making this idea resonate with that audience. And listeners, we only had time to really touch the surface of this paper. I encourage you, if this interests you, to search it out for yourself. It's called a Leverage Portfolio Management Approach, applying the CBOE S&P 500 2% out of the money BuyWrite Index. A lengthy name, but if you search for it, I guarantee you can find it, of course, over there on the Options Institute website, as well as on the Option Pit site. And I believe we even have it up at Options Insider. So no shortage of ways and places for you guys to get your hands on this paper and check it out for yourself, because it really is interesting stuff, and we love to see studies like this. All right, that's going to do it for our Volatility Viewpoint segment. Now we're going to keep on rolling right on into our Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, you know what time it is. It's time for the Volatility Review. This is indeed the portion of the program where we break down the week that was from a volatility perspective. We are recording this, of course, listeners, on Friday, September 26th, right around middle of the day, middle of the trading session here in Chicago. As we're recording this, most of the major markets rallying quite a bit off the heels of yesterday's big aggressive sell-off, and the VIX Cash, of course, taking it on the chin as a result. So it's been an interesting week from a volatility perspective. We'll start in the realm of VIX and indeed the VIX Cash, as we are wont to do here. It was a relatively tranquil week for the most part for most of the products until going into yesterday, of course, Thursday, when we saw that big pronounced sell-off across all of the major indices, and we saw a big spike in a variety of volatility products as a result, but not all. We'll get to that in a little bit. And of course, VIX Cash got, I believe, up into the 16 handle at certain points. It was an interesting week, to say the least. Russell, since you are our guest today, we'll give you pride of place, let you go first. What caught your eye in the week that was from a volatility trading perspective?
Well, what caught my eye, and this is a really easy Monday, it's not Monday, but a Monday morning quarterbacking of what went on was, the S&P closed on the lows on Thursday afternoon, but VIX did not close near, I think it was more than a point away from the high. So just the fact that people started to calm down, even though the S&P seemed to sell off into the close, it's kind of a sunny precursor to what ended up happening on Friday, at least through mid-afternoon on Friday. It's in just one other piece of that. I was chatting with one of the guys in the VIX pit as I walked to the train yesterday afternoon, and we were both talking about that kind of disconnect. And it almost felt like somebody toward the very end of the day had to bail out of the S&P 500 or threw the towel in, because it was, it wasn't met with an increase of volatility in the S&Ps. It seemed almost like a one-off event, as opposed to most of the day being a long grind lower.
Yeah, you're right. It was a bit of a weird disconnect towards the end of the session, because you're right, S&P's closing right down on the lows, and yet VIX towards the end of the day starting to come off a bit. People starting to realize, hey, perhaps this is a bit overdone. We've had pretty much 5 or 6% realized vol leading up until yesterday's activity, so there hasn't been a heck of a lot cooking. Maybe we've overdone it a bit here, just perchance. Jared, amidst all of that research you're flinging around over there at BGC Partners, what caught your eye in the week that was from a vol perspective?
Well, we're hanging loose on a Friday, and the market is too. I mean, after that big move on Thursday, things are calming down fairly quickly in real time as we talk. The VIX did get above 16, and I was watching the call skew in VIX options on Thursday, and that was a really interesting thing to look at. We wrote a little bit something about that for clients, and that what was notable was that you had VIX options, out of the money VIX calls, getting bid up very quickly and aggressively in some cases, relative to where the level of the VIX index itself was, in a way that looked like to be historically significant. So that was pretty notable activity. On Friday, the market's much quieter, and implied vol is coming back in, although it certainly hasn't reversed all of the gains from that Thursday spike. So I think that was pretty notable. But otherwise, except for action at the very front end of the curve, everything else seemed to be fairly orderly.
All right, and Jared, I know you have some new stuff you want to bring to the table this week. You've been looking into a lot of things we talk about quite a bit here on the show, but haven't had a chance to really dive into, and that's what's been going up OTC. Whenever we talk about these size trades going up in VIX options or futures or what have you, chances are there's another side that we're not seeing going up in the OTC variance land or the swaps land or all sorts of other OTC volatility products. And you've been digging away at that for our listeners and trying to shine a little bit of light onto that side of the fence. So what do you have for them this week?
So there's a centralized reporting agency, the DTCC, that kind of aggregates and reports on OTC trading activity. I have been looking at especially swaps going up, variance swaps going up for the S&P and some of the other equity indexes around the world. And there's been some meaningful activity as always in that market. I think that the clients are a lot different. So, for example, just looking at the trades that have gone up today, you see a lot of volume, notional values in December 2016 swaps, even in some years further out. I saw earlier this week that went up, and then plenty of activity, as you would imagine, in December of this year and some of the other months early into next year. But we're talking about price levels that are actually fairly consistent with what you might see if you looked at a comparable curve from S&P 500 index options, or even the VIX Futures curve. Although they don't map one-to-one, the shape of those curves actually tracks fairly closely. But it's interesting that even now, as equity option volume remains relatively low. There's been some anecdotal discussion of single name variant swaps, which is something that hadn't been traded for a long time during the recession, but maybe coming back. And then even potentially a little bit further down the road, a more robust market for swaps on VIX itself. So a lot of interesting things, I think, in the margins, but amidst all that, a pretty robust market for S&P 500 variant swaps.
Thank you for that, Jared, and we'll look forward to taking future glimpses into that side of the fence down the road in future episodes. Meanwhile, Mr. Greasy Meatball, Mr. Mark Sebastian, what caught your eye amidst the myriad whirlwind of volatility activity this past week?
Well, one thing that I was pointing out was that, one of the reasons why maybe the VIX kind of underreacted and didn't make some sort of wild move like we've seen on some of these other 30-point moves is because the spread was already ridiculously wide between realized and implied. And so what I feel like is the market basically just closed the gap, and then, like as Russell was saying, at the end of the day, the VIX really wasn't buying any of the forward move. And so the way I looked at it is, I think a big chunk of yesterday is a little bit of a one-off event. And, to me, that was the way things kind of lined up, is that I thought it absolutely could have been a one-off event. And so, that was really the big thing that caught my eye in terms of trading. Other pieces that were interesting, the Russell 2000 has really been the leader over the last week or so, and really last couple of weeks. And that was again showing the way. That's where the volatility is. And I know we're going to talk international a little bit, so I'll hold my tongue on that. But there's in terms of internationally, some of the things that we talked about last week are holding true for this week. So those were the main pieces that really caught my eye. The other final thing is that the Monday afternoon straddle purchase continues to be a complete winner and work really well. So maybe implied volatility is overpriced, but when you in a dynamically hedged environment, there's money to be made owning options.
So Monday afternoon, not Monday morning. You think Monday morning because it's been so beaten down and you want to get that pop. But Monday afternoon, after things have settled down, that's the time to do it?
Mm-hmm. That's exactly right. They come in and basically over-crush things Monday morning, and then you're really given an opportunity to buy the straddle at what amounts to a relatively cheap price. And then, typically either Tuesday or Wednesday or Thursday, we get some sort of wicked move, or we either get one wicked move down, or we get 3 10-point days up. And it's not that hard to make a couple of bones.
Speaking of what you said there, Mark, about how the VIX options and just the movement in general, what we saw in the marketplace, may have been a bit of a one-off event. It seems like that was the case, and it wasn't even that stellar of a one-off event. This probably alludes to kind of what Russell was saying as well, that VIX seemed to catch on pretty early that this was an odd thing going on because the S&P moving, VIX not so much. We saw VIX options do have a fairly robust day yesterday, of course, doing about 788,000 contracts, which is, of course, most products would kill for that. For VIX, that's just kind of a ho-hum day. When we saw not that long ago, just a week or two ago, a well over 1 million contract day on the S&P, moving far less than we did yesterday. And we did just about this many contracts again on the 19th very recently, and almost as many on the 12th. So this was not a record day yesterday by any means from an overall volume perspective, but there were some interesting trades going up, and looking at, of course, like we do every week, the hot strikes, what people are trading out there in VIX land these days. The number one strike, surprise, surprise, and still is, I think, well, we do have some puts at the bottom of the list this week, so we have some puts holding on to the top 10, surprise, surprise. But it is still, of course, a call trader's game out there in VIX land. Starting off with the OCT 20s, those are well over 300,000 now. That's a big bump from last week. 326,000 contracts open on that strike, down to the OCT 17s, about almost just a hair under 300,000. The NOVE 20s, 290. OCT 18s, 280,000 contracts. Then we drop off a bit. OCT 21s for 261,000. Jan takes all the way down to the number 6 spot before we get any really longer term vol here on the list. The Jan 20s at number 6 with about 226,000 contracts open. Then all the way back to OCK 22s and OCK 19s and OCK 515s are pretty much 221, 184, 155,000 contracts open. And way at the bottom of the list, number 10, listeners, the DEES 13 put, the mighty DEES 13 put, holding firm at number 10 with 152,000 contracts open. So despite all of this call love, and it is a call trader's game, a total 7 million and some change contracts open, 5.63 million of those being calls, only about 1.4 million being puts. Still, it is interesting to see that some puts did make it into the top 10 to the tune of the DEES 13s. We'll tune in next week to see if they can hold on there, if they get pushed away by all of this myriad call activity. Speaking of call activity, we did see some big trades going up yesterday, as you might imagine. The largest trade by far, we have to dig into this one a little bit because it's kind of odd, was a big trade, 81,000 to be precise, 81,600 of the OCK 22s going up for 58 cents. They went up below the bid. Looks like someone was just blasting out a ton of these things, and they needed to go pretty deep in to get them done. They went up here. Looks like they were marked as spread, but I can't see the other real side of this that went up spread off against anything here. There was a big call spread as well. Looks like the NOV 20 OCK 22 went up yesterday 37,000 times as well for about 63 cents. Again, looks like paper was selling NOV and buying OCK. I don't have the open interest here. So, of course, open interest on all these VIX strikes is a dubious beast because there's so much of it that's kind of hard to parse. But this could have been a closing, could have been a roll. It could have been a net opening out trade. And then, speaking of puts, we have the OCK 1312 put spread going up 20,000 times. Gotta love these. We like to call these love your broker trades. The one handle put spread going up for 20 cents. 20,000 times. Mid-market on both. Sizable open interest on both. So I'm not sure which way he was going on this. Let's assume he was closing and taking some of that money and going home. Otherwise, if you're opening up a $1 put spread for 20 cents, more power to you, sir. But some interesting stuff cooking out there in VIX land. Speaking of interesting stuff, and this really caught my eye, and I'd like to get your guys' opinions on this as well. We've talked about VXST a lot on this show. And you would think, listeners, that a day like yesterday, S&P moving, VIX popping, everything humming, would be a banner day for VXST. VXST, of course, being the short-term vol out here in S&P 500 in VIX land. And yet, that was not the case. The ADV in this product is about 900 contracts of late. So that's about what we've been seeing out there recently. Yesterday, in the height of all of this furor, all of this madness, this VIX-palooza, whatever you want to call it, a whopping 535 contracts went up. In fact, I'm looking at the top 10 hot strikes here, and there's pretty much no change from last week except for the October 1st cycle, 17 calls. They gained 200 and change for a total of 500 on that strike now. But that's about it. Russell, what do you make here? I think we talked about this when you're on your previous visits to the show. What do you make here of the kind of on again, off again love affair that the trading populace, institutional and retail, seems to have with VXST? Some days it really hums, and other days, like when you think it would be a slam dunk, like yesterday, or days going into non-farms, and other times when this product really should be singing, it just doesn't. It's an odd beast.
Well, I continue to think of it as more of an anticipatory product than a reactionary one. And we haven't, over the last 6 months, we haven't really had a bad GDP number or a really bad reaction to an employment number that I can remember. I was out of the country for one of them, but I don't think we've had a bad reaction to any of those things. So it's kind of like, a stock that seems to keep having a calm earnings report over and over again, and people get less interested in trying to play the volatility on those things. I almost feel like if, let's just say we have a bad employment report next Friday, October 3rd, that when we come around to the November employment report, traders who seem to be notorious for having pretty short memories might say, VXST did this on the last employment report. Maybe it's time for me to be taking a look at it. But I almost feel like we need to have a known unknown, which is one of those FOMC announcements, GDP number, employment number that people know are getting ready to come, and then actually do end up being a volatility event before we see it like the next leg of activity in VXST.
So you're saying we have to have a little bit more build up and then some sort of surprise, and then the next one we'll see some VXST paper.
Much like it's kind of a different space, but I think there's a similar mentality to it. I spend a lot of time looking at weeklies and the anticipation around earnings. And if, let's say, you've got a stock that normally moves 5% on earnings, if last quarter the stock jumped 15%, you're actually going to see, more often than not, you tend to see more anticipation in the next earnings report. And we just because we haven't had a volatility event around a government number or anything like that yet. I feel like VXST hasn't gotten the attention that you would want it to in anticipation of those events.
Interesting. We haven't had the scenario yet to build up the interest in or the love for VXST. Jared, you look at a lot of charts, you do a lot of these types of studies. What's your take on that? And also on the general non-event that was VXST yesterday?
Mm-hmm. Well, yeah, I have a theory about this, which is that the incentive for an investor to own VXST options depends just as much on some given event or catalyst in the very short term as much as it does on the overall volatility regime in a broader context. If you think about very low and medium and high volatility regimes, that you could probably come up with some rough characterizations of in terms of levels. I think the key factor for making a VXST position attractive is what the local minimum is likely to be. So what I mean is if you have some kind of a catalyst, even if it is anticipated to provide a big market move, and even if it actually does consistently, let's say, provide a big market move, if I'm holding some options and I feel like a lot of people probably do right now, that we're in a very low volatility regime, meaning that the index is going to plunge very quickly down after any meaningful event at all. I wonder if maybe that decreases the incentive to trade in these products, whereas if there was some potential for volatility to be to move on an event, but then to stay at some somewhat higher plateau or even to continue rising, like you would associate with medium to high volatility market regimes, then I think that the product actually might be a lot more attractive for a number of different kinds of users, and might get more traction in that sense, even independently there of the details of a specific catalyst. And if we do get a change in regime over the next few quarters, then my theory will prove to have been right or just wildly, wildly wrong.
I like it. There's no in between with you, sir. That's what I like. Mark, where do you fall on this ongoing VXST conversation/debate?
Yeah, I mean, I kind of agree with both of the guys. I think the other piece to think about is that right now there's really not a lot of vega risk in owning short-term options because vol is so low. So if we get to an environment where volatility increases back toward a more normalized regime of, the VIX of 17, 18, and there's some real risk in holding a weekly straddle, and there's some real risk in holding some 9-day options beyond just the gamma risk, and volatility can actually substantially hurt the position. That is when I think VXST will also see some more activity, when the vega could really move the P&L of a short-term position where, right now, most of the time with the VIX hanging around 12, it's lack of movement or gamma and theta that are really perpetrators, not the vega risk associated with a 9-day option.
Russell, before we move off of this topic of short-term vol, we haven't had you on the show in a while, and there's been some big changes in the way they calculate the VIX. Of course, we initially jumped on the news that they're going to use weeklies with the VIX, and we kind of, all of us on the show, thought it was insanity because it sounded like they were going to take, the front week product and incorporate it into the VIX and make the VIX a much more wild beast as a result. It turns out that wasn't exactly the case. They're taking weeklies that are much closer to that monthly VIX option right now, so they can kind of smooth it out a little bit. What's your take, Russell, on this new approach to VIX, and do you think it'll have a lot of meaningful impact going forward?
Well, The underlying options that are going to be used to determine VIX are always going to be within 7 days of that 30-day time window that we're trying to measure with VIX. And, at times we will have, in fact, I'm using an example in a video I'm putting together right now, where in mid-October, the November options are 28 days off, and the December options, I think, are like 53 days off. Well, those options that expire 53 days off don't, they contribute to the VIX calculation, but they don't really match up to that 30-day time window that you're trying to look at. So with the new methodology, which basically just takes the SPX options that expire just before 30 days and the ones that expire just after 30 days, you're going to have two series that are just about a month off that are going to give you a 30-day implied volatility measure. We are going to keep quoting quoting VIX using the previous version. So I'll be kind of interested on October 6th to put, and the ticker is going to be VXMO. I say MO for monthlies. I'll be interested to see VXMO and VIX versus each other over the course of the first couple of weeks, just to see how little or how much of a difference there is there. The thing not to be concerned about are the options and the futures on VIX. Nothing is going to change with respect to those guys.
Yeah.
And that's, I think that's something that everybody needs to be very aware of, that they're still going to use the same settlement process for VIX options and futures, and this should have no impact on either of those products.
Yeah, I think, Russell, one of the things that you and I have basically kind of said is maybe there's some marginal effect on volatility of VIX itself in terms of realized volatility, but the big difference is we won't have some of the major distortions because there won't be extrapolation of VIX, and there won't be some of the screwy things they have to do because it was just these two contracts. So aside from the times when VIX is kind of really distorting, I have trouble seeing any major differences. What I think will happen is we'll see in those distortions where VXMO, kind of pops and then drops, or then drops and then pops, will just kind of end up being the regular VIX. Will just be the average of that number or something along those lines.
Yeah, I didn't know they're going to be disseminating the old, quote unquote, old methodology as well. So that'll be interesting to see that side by side for a while. You're right.
This is actually the first time I've said that publicly.
Well, there we go. That's why I didn't realize it.
It's not a secret or anything, but it's just it's something that I learned of in a meeting here at CBOE, I think 2 days ago. So
yeah,
but it's
and Russell, maybe you want to point toward maybe another reason why we would use these VIX options, why we would use this new calculus. They haven't announced it, but what do you think what does this really allow the CBOE to do if it ever becomes something they would want to do?
Well, and this was said at our risk management conference in an open forum. But if you think about it, right now we don't trade weekly options on VIX, and the reason we don't trade weekly options on VIX is because we are settling VIX futures and options to an option series that's 30 days out in the future. And only 12 times a year do we have, for the current VIX calculation, an option series that is exactly 30 days out in the future. Well, if you start using options that are always expiring pretty close to 30 days out in the future, you would have the ability to create a VIX settlement price every week. And if you can come up with a VIX settlement price every week, you can also trade options and futures that might settle every week.
There you go. The well-laid plans. I can only imagine how much of a home run the weeklies on VIX would be, because that just pretty much gets right into the wheelhouse of what a lot of people using that product want to trade it for, that very, very short-term time horizon. Again, why VXST has been such a bit of a head scratcher for us here on the show. I know we like to get in some other vol and some other products people like to talk about. We're running a little bit long here. That's why I love this show. Time just flies by once we start talking about all these various topics. But we will touch on some of the other asset classes really quickly as well. Listeners, starting off in the metals realm. We talked last week about how gold puts were just catching a bid. That continues this week. We're looking at the skew charts here for all the big futures options out there on gold, and the puts are looking fairly rich, particularly particularly in the nearer portion of the term structure there for the futures, fairly rich. The surprise coming out of that, it was last week, you remember, listeners, we talked about silver still being fairly into that symmetrical smile type of curve. Didn't seem to be any bias one way or the other from a vol perspective. That seems to have changed this week as well, as the narrative has shifted more closer in line to what we're seeing with gold, with the puts catching a serious bid out in silver these days as well. So looks like the interest, the concern, the premium on both of those shiny metal products coming in on the downside. And just rounding it out here on oil and energy, as we like to check in as well, looking at the crude. And crude is actually, these three charts, you can almost superimpose them on each other, and you think you're looking at the same one, because the richness, the bid is coming in on the puts here in crude as well. And that might surprise a lot of people, because crude, I know, got down to the low 90s and then bounced off that handle, seemed to be having some strength. But clearly the concern these days is beyond and to the downside here. So a lot of the puts catching bids out there as well. Jared, does any of this, I suppose you can call it put palooza out here in any of these products surprise you? Is this pretty much what you expected after this week's developments?
You know, as this continues, I think it's giving some justification for people who've been looking for a kind of a multi-year bottom in volatility in currencies and commodities, and even fixed income. And I think at some point, maybe not just yet, but you know, it's going to be time for people to think really hard about whether price-wise there's a lot more downside to come for commodities, and vol-wise whether there's some flat to significant upside for the whole complex. I mean, it's certainly in gold and silver, as you pointed out, but even natural gas, coffee, soybeans, sugar, all have implied vols that are well above the median. I mean, in the case of those agricultural products, some of those are in the top decile versus the last couple years of data. So you've got some really meaningful moves. Same thing in currencies. You know, the majors, it's not a huge move yet, but a lot of the G10 currencies are, you know, out of that bottom third of recent implied vol levels and are creeping back toward the median. And so as you start to see this movement around the world in these non-equity products, I think it really bolsters the case for people who are looking for maybe a regime shift in volatility in the market.
Yeah, you're right. I mean, we only hit on 3 product categories here, but you can get into the ag, similar stories in the ag, similar stories, like you said, in currencies. You could take this same skew chart and almost superimpose it across a variety of different product complexes these days, and you'd be seeing similar stories developing. So that certainly bears watching. Maybe we need to have a commodity vol today show coming up or something like that, because there's a lot afoot out there in the commodity realm. But before we close out the volatility review here, Jared, I know you like to cast your eye, your glance beyond the shores here of this here USA into all the other doings in the volatility space around the globe. There certainly has been no shortage of those of late. Give us what your international vol tracker was watching for this past week.
You know, for once, I think that the U.S. Has some richer options than a lot of other places around the world, which hasn't been the case on a lot of occasions this year. Just on a percentile rank basis, some of the big U.S. indexes like the NASDAQ and the Russell 2000 look more expensive than most of the other developed markets, certainly around the world. Maybe an exception there is Japan and maybe Australia, but otherwise, a lot of the European indexes have, you know, after that Scottish referendum and change in the ECB policy, they've at least in terms of overall pricing relative to their own histories, they're a little bit quieter. So I think that the emerging markets are a different story, and those are obviously having to do with policy changes and dollar strength. But right now, in terms of richness of premium, I still think that the U.S. is the place to look.
And Mark, what are you watching? I know you pay a lot of attention, particularly to Brazil and a lot of the emerging market vol. What are you watching out there these days?
Yeah, I mean, that's just it, is that, you know, if you look at other world markets, you know, you're right. The U.S. is rich. We're seeing some real richness, if you will, in some of the lower end emerging markets. It's where really maybe volatility is somewhat cheap, surprisingly, is in some of the more developed, slower moving economies. I mean, volatility in things like in Europe and some of those areas is actually relatively cheap when you look at the U.S. or you look at the emerging markets, especially Brazil. Brazil vol is through the roof into this election. So which is kind of interesting if you consider that, the U.S. economy, we're coming off of 3 years of really low VIX and a completely stagnant U.S. economy. Now that the U.S. economy is starting to do well today, we were near 5% on the GDP. VIX is starting to break out, and we're seeing kind of the opposite happen in Europe. So I'm a little flabbergasted that there's this weird kind of GDP VIX relationship that is just right now anecdotal, but it's going to be something to watch.
That will be something to watch. Unfortunately, we have to cut it there for the volatility review. We'll come back and check on that next week. And now, I'm sorry, listeners, we went so long on all these other great topics, we won't be able to dive into the listener mail. We'll save them for next week. But meanwhile, we'll wrap things up right now with our Crystal Ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, you know the drill by now. This is indeed the portion of the show where we prognosticate recklessly and indeed wildly for the future, for what the vol gods hold in store. Russell, since you are our guest, you get pride of place. You get to go first. What is your reckless and indeed wild prognostication for the week to come from a volatility perspective?
From the week to come, goodness, I wanted to look 2 weeks out.
Okay, we'll give it to you if you want.
It was just mentioned in passing that the implied volatility down in the Brazilian market is awfully high. Watch, I believe October 5th is the first round of elections in Brazil, and right now the market seems to be pricing in that they're going to have a second round toward the end of October. When you start to get some certainty around that thing, you're going to see a big implosion of volatility. I visited India, and I was there during their national elections, and you saw a huge volatility crush right after their national elections were over with. And I almost expect Brazil to follow the same pattern in October.
And Mr. Sebastian, what are you expecting for the week to come?
Yeah, I mean, I think, like I said, Thursday looks like a one-off event. I think that you'll see the VIX creep higher into non-farms and then probably flush out. What's interesting is they've actually been flushing out vol on Thursday before non-farms rather than non-farms themselves. So if one is looking to sell premium into a non-farm payroll, I think Wednesday is the day to do it, not Thursday. Thursday, what's ended up happening is they've kind of pre-crushed volatility, and then these non-farm payrolls have been kind of like when you think you're about to have a really big fart and then it just ends up being silent gas. That's kind of what non-farm payrolls have been the last year or so.
That's why we like having you on the show, Mark. We can always turn to you for the colorful metaphors, the very family-friendly stuff we like to discuss here on the old program. All right, Jared, save us, sir. What are you expecting for the week to come from a vol perspective?
Well, I think the international markets are more like a spleen, and if you No, I don't. I can't follow that metaphor.
Don't even go down that rabbit hole, sir.
I think more prosaically, I think that this lift in implied vols this week should be good for some short vol traders. The VIX straddle strategy that we've been profiling has worked really well. I think this is going to be good for that approach in the near term. I think that there's some weekly option traders out there on the short side who might have gotten a sting this week, and I'm looking for the leverage at that very, very front end of the curve to gradually decline into the end of the year. But otherwise, there's the economic data is just too good. I mean, there's some anecdotal signs of improved capital expenditure in the U.S., and if we get some meaningful increases in wage data, we could be off to a whole new race. So I think there's a lot ahead to look for, and that the time to be casual about strategies is over.
All right, that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views. But before we go, as always, let me check in with each of my cohorts, my partners in crime on the old Volatility Views panel to see what they have coming down the pike that may interest you. Russell had to run, but listeners, if you want to find out more about that white paper we talked about or anything else that he's working on, surf on over to theoptionsinstitute.com. You can find all of his research, all of his papers, all of his work there. And also check out his books available in Amazon and other fine book retailers. And Mr. Sebastian, what is coming down the line in the land of the pit that may interest our listeners?
Well, if you want to check out the white paper that Russell and I worked on, you can go to www.optionpit.com/whitepaper, and it'll take you to the post that I did that has my contact info, Russell's contact info, and a link to download the white paper right there. So optionpit.com/whitepaper. In terms of OptionPit itself, on October 4th, that's a week from Saturday, we have our VIX Primer. It's going to be a 2.5 to 3 hour course where we're going to discuss volatility, VIX, the VIX ETPs. We normally do these for about $147. We're just doing it for $47. So go to optionpit.com/VIX Primer to check that out, or optionpit.com/events to see everything on the calendar.
All right, good stuff. And last but not least, Mr. Jared, what's coming down the pike over there from BGC Partners?
I got a couple things cooking. Fourth quarter event gamma paper coming out. The third quarter one we did was pretty popular, and looking at some specific risk scenarios that I'm watching and trade ideas to take advantage of those. I'm also working on a new systematic strategy that should be ready in the next several weeks, let's say. And then also the long volatility regime view that we alluded to on this program actually is something I'm working on for a little bit longer term, but taking a deep dive into some history and relationships to see what we can make of that. So quite a lot going on over here in New York.
All right, and surf on over to bgcpartners.com, listeners, if you want to learn more about what Jared is cooking up over there. And on behalf of Jared and Russell and Mr. Sebastian and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Don't worry, we'll get to them on the next episode. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.